Thank you so much for that, Ashesha, for bringing us that story with regard to deleveraging. But let's bring on board Unmesh Sharma, who's the head of institutional equities at HDFC Securities, joining us this afternoon. Unmesh, great having you. How are you placing your bets in this market, and how are you viewing the market at this point? Give us a sense of what you're looking at in terms of where the market is headed maybe 3-6 months from now.
Thanks for having me on your show.
Great having you.
So it's been a very confusing market in the sense that there has been one major cross flow, which is that on the global front there has been selling, and on top of that, as people await the trade deal, there has been weakness in the currency. On the other hand, the domestic flows, including the data that was received yesterday, continue to remain very strong. As a result of this, what started to happen is that we've also seen that while the indexes are going up, if you look at client portfolios, especially those in multi-cap or small and mid-cap, have actually taken a fair bit beating. So currently, what everyone wants to know is not just where the Nifty is going, but also whether there is whether the selling on that front will stop. So to answer that part in two parts, one is that if you look at headline Nifty, given the fact that despite the fall, it has been one of the worst performing global markets this year. Okay, at this point in time, in December, a lot of the FPIs do not take fresh bets, so we'll have to wait till January. But we recently visited the US, and what we found is that incrementally there doesn't seem to be that much interest in going further underweight on India. So, and that can show up a little bit, that has shown up a little bit on the awaiting of the selling as well. On the other hand, what's also happened is that the market's not really cheap. And as people start to look at what happens in the quarterly earnings, commentaries and outlook for the FY27, we will start to see the direction in the market. It looks like it will remain range bound with a clear bias towards large caps and only those small and mid caps where actually earnings delivery is certain. So next 3, 6, 12, 9 months we expect to be extremely challenging. Our model portfolio has a strong bias towards large caps, has a strong bias on the mid caps and very specific stocks, and to a large extent is domestic facing.
Okay. And Unmesh, so let's talk first about the global setup. Tariffs, you've got rate cuts across the world, and you've got a possible exposure to India, export-facing sectors, plus you've got a depreciating rupee. How do you play these 3-4 themes, which are more global-facing? IT, of course, is the one good way to play it, but at this point, is the risk-reward looking attractive there, or is there another way you play these themes?
So if you look at it from the index perspective, the big issue is that if you break down the earnings, the tariffs per se do not affect earnings as much because still dominated by domestic sectors. Having said that, that small component of IT and pharma to a large extent, which is driven by the foreign trends, is mostly indexed to the US. So from that perspective, it does make a difference. Now, in an environment where services have not been taxed and the H1B is really not such a big issue,
right? And
the depreciating rupee, the IT sector would have been an obvious one to bet on. The problem there is that
Unmesh, I have you on a bad feed, so I'm going to have to pause you there, and we'll come straight back. We'll try and repair that and come straight back to you for that answer. Kunal, within the IT pack, well,